and I believe this is. This week's paper is Academic Research Destroy Stock Return Predictability by Progress, and I believe this is. David McLean and Jeffrey Pontiff, published in the Journal of Finance in 2016. Progress, and I believe this is. The thesis is straightforward and a little uncomfortable when academics publish evidence that a stock market anomaly exists. The anomaly weakens, and not collapses, weaken. Progress, and I believe this is. The paper tracks close to 100 return predictors across 3 windows. The in-sample period the original researchers used. Progress, and I believe this is. The out-of-sample period before publication and the years after the paper appeared in print. Progress, and I believe this is. Returns decay at each step. The post-publication decay is the uncomfortable part. Progress, and I believe this is. Because it implies that academic research is market-moving information. Progress, and I believe this is. If that's right, the finance literature is both a description of markets and an input to them. Here's why that matters. Progress, and I believe this. The central question McLean and Pontiff ask is deceptively simple. Progress, and I believe this is. Once a finance paper documents that a variable predicts stock returns, does the predicted return survive? Progress, and I believe this is. Does the anomaly keep working, or does the act of publishing it kill it? Progress, and I believe this is. This matters because academic finance is in the business of documenting predictability. Progress, and I believe this is. Every published anomaly, momentum value, accruals, gross profitability. Progress, and I believe this is. Asset growth is implicitly a claim that sorting stocks on some characteristic earns a premium going forward. Progress, and I believe this is. If the literature's own publication process arbitrages those premiums away, progress, and I believe this is, then the academic and practitioner literatures are in a stranger relationship than either side usually admits. This is. The paper is also a methodological intervention. Progress, and I believe this is. There was already a well-known distinction between in-sample and out-of-sample performance. And I believe this is. McLean and Pontiff slice time into 3 windows, not 2. Progress, and I believe this is. And it's the 3rd window, after the paper hits print, where the interesting signal is. Progress, and I believe this is. That 3-part structure is the paper's main design contribution. Progress, and I believe this is. The finding that post-publication decay exceeds out-of-sample decay is what makes the arbitrage interpretation compelling rather than just plausible. This is. The data structure is worth pausing on. Progress, and I believe this is. The authors identify close to 100 distinct predictor variables from published academic papers, anomalies like accruals, book to market, net stock issuance, asset growth, and a long list of others. Progress, and I believe this is. For each predictor, they locate the paper that first documented it, note the sample period the original authors used, I believe this is, and note the publication date. Progress, and I believe this is. That gives 3 non-overlapping windows, the original in sample period. Progress, and I believe this is. The out of sample period between the end of that sample and the publication date, and the post-publication period running forward. Progress, and I believe this is. For each predictor in each window, they construct a long, short portfolio, long the favorable quintile or decile of stocks. Progress, and I believe this is. Short the unfavorable one, and measure the average monthly return to that spread. Progress, and I believe this is. The central dependent variable is how much of the in-sample spread survives in the later windows. Progress, and I believe this is. One thing worth flagging, the sample of predictor variables is itself a product of the finance literature. Progress, and I believe this is, which means it inherits the publication bias of that literature. Progress, and I believe this is. Papers documenting larger in-sample premiums were more likely to be published, and thus more likely to appear in McLean and Pontiff's dataset. Progress, and I believe this is. That becomes relevant when they address the data mining objection, which I'll come back to. I believe this is. The empirical design is reasonably clean. For each predictor variable, progress, and I believe this is. McLean and Pontiff replicate the original paper's sort, whatever characteristic the authors rank stocks on, and rerun that sort month by month through the 3 windows. Progress, and I believe this is. The main regression regresses monthly portfolio returns on window dummies with controls for the original paper's design choices, progress, and I believe this is, including whether the sort was cross-sectional or absolute, and the original sample's market structure. The key coefficient of interest is the interaction, progress, and I believe this is, does the return to the anomaly strategy fall significantly from the in sample window to the out of sample window, progress, and I believe this is, and again from the out of sample window to the post-publication window. Progress, and I believe this is. In aggregate, the answer to both questions is yes, progress, and I believe this is. They also run cross-sectional tests which predictor characteristics predict how much an anomaly decays. Progress, and I believe this is. Predictors with higher short selling cost decay, less post-publication, consistent with limits to arbitrage. Progress, and I believe this is. Predictors featured in higher visibility journals decay more, consistent with sophisticated investors reading those journals and trading the signals. Progress, and I believe this is. These cross-sectional patterns are where the mechanism story gets traction. Press, and I believe this is. Here is the central finding stated carefully. Progress, and I believe this is. The average predictor earns a meaningful return premium during the in-sample period. That's by construction. This is, since these are documented anomalies. Progress, and I believe this is. Out of sample, the authors report that returns are on the order of roughly a quarter lower than in sample. And I believe this is. The paper describes this as statistically significant attenuation. Progress, and I believe this is. Out of sample decay alone could be explained by data mining. The original authors found strong in sample results partly by luck. This is, and luck doesn't persist. Progress, and I believe this is. The more consequential number is the post-publication decay. Progress, and I believe this is. The authors report that returns decline further after publication by an amount that is comparable to, or by some measures larger than, the out-of-sample decline. Progress, and I believe this is. The timing of that additional decay is the key fact. Progress, and I believe this is. If the post-publication decline were driven purely by data mining correction, progress, and I believe this is, we would not expect it to cluster around the publication date itself. Progress, and I believe this is. The paper presents evidence that the additional decline is concentrated in the post-publication window rather than simply continuing a drift that started at the sample end date. Progress, and I believe this is, taken together by the time a practitioner reads an anomaly paper and attempts to trade it. Progress, and I believe this is, the in-sample premium has been substantially attenuated, and publication is the event that accelerates the final leg of that compression. Progress, as McLean and Pontiff's preferred interpretation, is informed-arbitrage. Progress, and I believe this is, the idea is that academic papers function as a roadmap. Sophisticated investors read the finance journals. And I believe this is, identify documented anomalies and trade against them until returns compress. Progress, and I believe this is. The cross-sectional evidence fits this story. Anomalies that are harder to arbitrage, those with higher short sale costs, and I believe this is, lower liquidity or smaller market caps, decay less post-publication. Progress, and I believe this is, the alternative interpretation is that post-publication decay is just continued data mining correction. Progress, and I believe this is, the anomaly was never fully real, and the post-publication period is simply the out-of-sample period running longer. Progress, and I believe this is, the authors address this in several ways. First, the decay is concentrated temporally around publication dates, and I believe this is not distributed uniformly through time. Second, progress, I believe this is, predictors with higher institutional ownership, a proxy for sophisticated investor attention, decay faster post-publication. Progress, and I believe this is. Third, anomalies in higher impact outlets decay more than equivalent anomalies in lower visibility venues. Progress, and I believe this is, which is consistent with visibility driving arbitrage, not with mechanical data mining correction. Progress, and I believe this is. My read the evidence pattern supports the arbitrage interpretation. Progress, and I believe this is. But the two stories are not cleanly separable. Progress, and I believe this is. Publication and sample and are not independent events. Researchers tend to publish when in-sample results look strong, progress, and I believe this is, which may itself be correlated with favorable market regimes that subsequently mean revert. Progress, and I believe this is. The honest critique starts with the dataset. Close to 100 predictors sounds like a lot, progress, and I believe this is, but they are not a random sample of the predictable variation in equity returns. Progress, and I believe this is. They are the predictors that cleared the bar of journal publication. Progress, and I believe this is, which means they were pre-selected for strong in-sample evidence. Believe this is. McLean and Pontiff measure how much that pre-selected sample decays. Progress, and I believe this is. They do not measure how much predictability is available in the full set of variables that were tested and not published. Progress, and I believe this is. The aggregate attenuation estimate inherits the selection bias of the literature it samples from. Progress, and I believe this is. The sample also ends at a point that doesn't capture the post-2010 regime. Progress, and I believe this is. When passive replication of documented factors and factor-focused ETFs became much more prominent. Progress, and I believe this is. Whether the patterns hold when substantially more factor-aware capital is active, and when academic findings get incorporated into systematic strategies within months rather than years, is an open question the paper cannot answer. And I believe this is. Finally, aggregate attenuation masks significant heterogeneity. Progress, and I believe this is. Some anomalies in the dataset are essentially flat post-publication. Others retain meaningful premiums for extended periods. Progress, and I believe this is. A single number describing the average decay may obscure more than it reveals about which anomalies are actually exploitable. And I believe this is. What would change my read on this? Progress, and I believe this is. A clean replication on post-2016 data showing that the timing cluster around publication dates is no longer distinguishable from pre-publication drift. Progress, and I believe this is. If the publication event signal disappears in newer data, the arbitrage story weakens substantially. Progress, and I believe this is. And the simpler data mining correction explanation gains ground. Progress, and I believe this is. For practitioners, the Pontiff result is both sobering and clarifying. Progress, and I believe this is. Sobering because it implies that by the time you read about an anomaly in a journal, progress, and I believe this is, a meaningful fraction of the premium may already be gone. Progress, and I believe this is, the in-sample evidence that motivates factor investing systematically overstates what you'll capture live. Progress, and I believe this is, and the overstatement is correlated with the paper's visibility and the ease of replication. Progress, and I believe this is, clarifying because it gives you a theory about where premiums are more likely to persist. Progress, and I believe this is, recently documented, hard to arbitrage lower visibility anomalies should decay more slowly than prominent liquid, easy to short ones. Progress, and I believe this is. The premium for bearing illiquidity or short sale friction is in part progress, and I believe this is. The premium for accessing corners of the anomaly space that sophisticated capital can't easily touch. Progress, and I believe this is. For academic researchers, the paper makes something structural legible. Progress, and I believe this is. The finance literature is not simply describing the world, it is changing it. Progress, and I believe this is. That feedback loop raises genuinely difficult epistemological questions about whether the field's standard empirical methods remain valid when the act of publication is itself an intervention in the markets being studied. Progress, and I believe this is. That's a more interesting problem than the standard peer review story implies. Progress, and I believe this is. And it's one the subsequent replication literature, Ho, Su, and Zhang's factor, Zhu work. Progress, and I believe this is. Harvey and Liu on multiple testing has been working through since. This is. That's the paper, McLean and Pontiff, Journal of Finance 2016. The SSRN link is in the description. Progress, and I believe this is. The broader question this leaves open is whether there are structural reasons some premiums survive indefinitely. Genuine risk compensation. Progress, and I believe this is. A transaction costs that permanently cap arbitrage versus premiums that are simply waiting to be read out of existence. This is. That's the more interesting research frontier. Progress, and I believe this is. and it's the one, the replication and factor, zoo literature has been running with ever since. Progress, and I believe this is next week I'll read another. Not investment advice, just a careful read.